So at first blush, this looked like a pretty robust earnings beat. Adjusted earnings per share well ahead of the consensus, but the story appears to be the story that markets are latching onto is provisions for credit losses, which were about double in the most recent quarter what they were a year ago.
Yeah. Well, investors are rarely going to give much credit for a bank when an earnings beat comes from capital markets.
Right.
And along the same lines, investors are rarely in the mood for a miss on provisions, especially not in an environment like this.
Where do you think provisions are going for the group? I mean, I've talked to some people who believe the peak is coming, and before too long, we're going to see provisions track down, which is a significant tailwind for earnings per share.
Well, it depends on the bank, and we just heard an update from you on Trump's tariff plans, and that, of course, is still up in the air. We would all love to see picture-perfect guidance from the banks on how those tariffs will impact the banks. But of course, none of us know what tariffs will come, when they will come, how long they will last, what the retaliatory measures will be, or anything like that. So it's understandable that the banks are in wait-and-see mode, just like the rest of us.
Mm-hmm. What's your take on bank earnings season thus far in terms of trends that we've seen?
Well, one of the big trends we've seen is that the consumer in Canada is under strain, and that's quite worrying even before we see any impact from tariffs. The good news is, on that front at least, we are seeing mortgage loans still perform quite well as borrowers are benefiting from lower rates. I'd say one other thing to add, whether you saw earnings from EQB today or from BMO yesterday, you're seeing some banks that had bank-specific issues on the credit front start to turn the corner, which perhaps is what you were alluding to.
Right. Does that include BMO? Because there has been, as you know, some focus on BMO as being an outlier in a negative way on credit experience in the U.S. In other words, underperforming its peers. It's banks that lend to the same type of clients in the same geographies of the U.S. BMO was thought to be experiencing more losses than typical there.
Well, some focus is one way of putting it. It was a really ugly year for them last year. All 4 quarters, they were by far the worst performer. So you could call it a relief, you could call it a rebound quarter. In any case, it was a good sign that we saw them turn the corner on their U.S. commercial loan book.
What did the market like so much about those BMO numbers? Is that it, the credit experience in the U.S.? The stock was up close to 5% yesterday.
Well, I think part of that was just that the stock was pricing in quite a bit of fear based on how bad the numbers were last year.
And Bank of Nova Scotia, it also reported results yesterday, and I think loan losses were the concern there as well.
And they will probably continue to be the concern. Scotiabank is the most exposed to tariffs out of all of the Canadian banks. They've got a big business in Mexico, in addition to their Canadian banking business. And so we do like what Scotiabank has done under new CEO Scott Thompson. I know you'll be speaking to him soon. So we appreciate that Scotiabank is doing the best with what they can control, but they are, as much as anyone, facing some dark clouds this year.
Let's put up a graph of Toronto Dominion Bank, ticker symbol TD. That stock has rallied pretty significantly recently. There you see it, a big move since the middle of December. We know what the story on TD Bank is, big regulatory issue in the United States, although there is clarity now. And often these bank stocks, when there's clarity on a very negative regulatory decision, we see stocks lift. And that seems to be the case here in TD. What's the market thinking on TD here?
Well, I'd say there's more clarity. I wouldn't say we've quite reached the other end of the tunnel just yet. And maybe you could say it's similar as what we just talked about with BMO. You're starting to see a little bit of a relief. You're starting to see investors starting to get more optimism. We'll see tomorrow and in the years ahead how well-founded that optimism is. But TD has made some steps, and we'll see if they can keep this trend going. And
you mentioned EQ Bank a short time ago. I'm seeing that you don't have a formal rating on that, but what do you think of these smaller lenders here in Canada, the lenders to clients who may not be able to be served by the larger banks?
Yeah, so first of all, you're right, we don't have a formal rating. Our coverage and our clients are more focused on the larger banks. That being the case, EQB does deserve a lot of credit for what they've been able to accomplish. And look, they've done very well for a number of years now, serving the underserved borrower on the mortgage side. And at these levels, there is a compelling case for the stock still trading at a fairly significant discount to most of the Canadian banks.
Ben, thanks a lot for joining us.
Thank you for having me.
Ben Sinclair is an equity analyst at Odlum Brown. As you just saw, he covers the Canadian bank.